Ryan Brady. I am a VP of Capital Markets with Matthews Real Estate Investment Services here in Tampa, Florida. And I wanted to take about 5 minutes just to kind of tell you what's going on with the commercial real estate lending market. Let's dive right into it. What I want to talk about is, what's up with rates? Where are they? Where are they going? What can you expect if you're applying for a commercial real estate loan? Who is making those loans? Who are the lenders who are active, and who are the ones that you need to be scared of? And then finally, how to get in contact with me. So let's start off. Let's dive right into it. Commercial real estate loans almost always, not exclusively, but almost always are priced off the 10-year Treasury yield. So let's take a look at what the 10-year Treasury bond has been doing, and that will give us a read on what we can expect. Okay, so here's where the 10-year Treasury yield is today. It's at 4.473. But I want you to take a look. I mean, if you go back in time, let's just take a look and see where it was a month ago. A month ago, it was substantially lower. Here's a three, and this just gives you on what's been going on the last 3 months. Back at the beginning of April, it was down around 4.2. And if you go back all the way to the beginning of February, it was down around 4.1. If we go back over 6 months, you'll see what's happening. I mean, the 10-year yield is right about where it was at the around Thanksgiving time. And then here's the really cool part. If you look at going back 1 year, you're going to see that we're actually about 100 to 110 basis points higher. So commercial real estate loans a year ago were about 1% lower than they are today. What's that mean? Well, if you've been following me here on LinkedIn, you'll know that in December, nothing really changed in the Fed. If you looked at the FOMC minutes, the Federal Open Market Committee minutes, nothing changed. They were talking that there might be some rate cuts in 2024, but they were really worried about inflation. But the Fed chairman went on TVs and went out to all the talking heads and gave everybody a Christmas gift and said, we might have 3 cuts in 2024. Well, that, my friends, is off the table. Maybe we see one later this year, but Wall Street right now is really digesting the fact that we're not going to see Fed cuts anytime soon. So what's that mean? It means if you're going to see a cut in 2024, it's going to be late in the year. I just saw a stat today, a chart that all that COVID-free money is gone. It's been spent, and that consumers are now not just flush with cash, but they're starting to add to their credit card balances. That means consumer spending is probably going to slow towards the end of the year. And when that happens, we're probably going to see an economic slowdown because the American consumer drives so much. So if you've got commercial real estate debt that matures in 2024, you better talk to me now. Don't wait. Rates aren't going to get better this year. And if you're holding on for lower rates, you could be holding on to the first quarter or second quarter of 2025. So having said that, where are the capital sources? Don't bank on banks and give credit to credit unions. Banks and credit unions have always been good commercial real estate lenders. But I can tell you in the last couple of months, banks are shying away. We've had banks back away from 2 deals. These were term sheets they issued. They started processing them, and they got halfway through the project, and they backed out of the deal. Now, this I didn't originate the loan. It was from our sales guys dealing with an outside lender. The buyer came in with their own lender. It was a bank, and the bank backed away from the deal. And they found 1,001 reasons, but the simple fact is, I don't think banks want to make loans on commercial real estate. However, credit unions are a great capital source right now. A lot of the smaller single-tenant net lease deals that we're doing, we're getting funded through credit unions. And their rates are still pretty decent, and they're actually executing and following through and funding the loans. So where are the rates? Where are the lenders lending? Well, for low leverage deals, these are going to be like 60 to 65% leverage, 1.5 or greater debt service coverage, primary markets, maybe secondary markets. Life insurance companies are a great source of capital. And right now they're putting money out at around 6.3 to 6.8%. Banks, if they close, are quoting deals in the 7 to 7.75 range. That's if they close. Like I said, in the last 3 months, I've had 2 loans come to me from banks that backed away from deals, and I've not used a bank to fund a loan. However, credit unions are a good capital source. Like I said earlier, they're lending around 6.75 to 7.25. For multifamily, Fannie and Freddie small balance loans are around 6.9 to 7.1%. Small balance meaning up to 8 million. And for conventional loans, which are typically over 8 million, you'll see a much better rate. So the Fannie Mae, Freddie Mac conventional loans are around 6.1 to 6.3%. One of the big surprises this year were CMBS lenders. They came on right around February or March. Their spreads compressed, and they've been lending out at competitive rates. Last year, they were non-existent. They just weren't in the market whatsoever. But CMBS lenders are in the market. And on the next slide, I'm going to talk about why I've been quoting so many deals CMBS. Their rates are probably 7 to 7.75% right now. And then finally, I just want to include this because when we look at what's happening in the drugstore sector and even a little bit in the QSR, the fast food restaurant sector, we're seeing a lot of these companies start to close properties, and they're not renewing their leases, or they're just moving out of them and paying the leases, but the property's vacant. We do have lenders for that. If you have a vacant property, like one of the guys in our Tampa office has I think it's a Pollo Loco or a Pollo Tropical that is now vacant and is for sale. But you can certainly get financing for that property, even though there's no current income. We have bridge lenders out there who will lend in about the 9.5% rate for an interest-only loan, but they're only going to go up to about 50% of the purchase price. So if you're buying a $3 million vacant fast food restaurant or a vacant drugstore, you could be able to borrow about $1.5 million and get some leverage on that deal. Then you can get that thing leased up with a new tenant, and then you can get some permanent financing after that tenant's in place. I mentioned CMBS. There's really 6 words you need to know about CMBS lenders. Higher proceeds, full-term interest only. CMBS lenders write off the interest-only payment, which is going to be lower than an amortized payment. And because they underwrite off that full-term interest-only payment, the loan amounts that it yields are higher. So there have been a couple of multifamily loans that I quoted in the past month where I might show $2.5 million in proceeds at 7 1/8 with an agency lender. But when we look at it with a CMBS lender around 7 3/8, maybe 25 basis points higher, we're able to yield an extra 10%. We're able to get like closer to 2.8 million. So that's been a savior for some people who are trying to refinance commercial real estate debt in the multifamily space. They're finding that CMBS is getting them the higher loan amounts that they need to refinance their maturing debt. Finally, if you're trying to get in touch with me, here on my LinkedIn, you've got my phone numbers right there. I answer the phone. Give me a call if you have questions about commercial real estate finance. I'm happy to help you. Have a great day. Make it a great May. Take care.